If you suck at investing, it's probably because you're a human being. Unfortunately, our psychological makeup makes us susceptible to certain investing pitfalls that can really drag down your portfolio performance over time. But don't worry, once you're aware of these things, they're actually pretty easy to spot and avoid. Trying to time the market is one of the most classic mistakes that both beginner and seasoned investors continuously fall prey to. The desire to optimize your returns is very natural, but the fear of choosing the wrong entry point can make you sit out on the sidelines for months or years, losing out on a ton of potential investment growth. But the problem with trying to time the market is that you are just as likely to be wrong as you are to be right. Stock market valleys and peaks seem obvious in hindsight, but they're actually really hard to accurately predict when you're in the middle of one. The best thing you can do is engage with a dollar cost averaging investment strategy, which essentially just means that you invest your extra cash into the stock market as soon as it's available to do so. This diversifies your entry points. For example, if you commit to investing $100 per paycheck and you get paid 24 times a year, that means that you're entering the stock market 24 distinct times. Some of those entry points might be high, some might be low, but they'll roughly average out, and your portfolio performance will more closely match the performance of the stock market generally over time. Even financial professionals who get paid outrageous sums of money cannot reliably pick stocks above and beyond the performance of broad market index funds over really long periods of time, especially when you consider their pretty extreme fees for their services. And just being brutally honest here, if the financial professionals with years of education who make this their full-time jobs can't reliably do it, what makes you think you can? Stock picking, just like timing the market, feeds our natural human desire to feel in control at all times. You feel connected to a specific company, either because you're a consumer of their product, you read about them in the news, or a trusted person like a friend or a colleague or a social media influencer recommended them. But it's really important to remember that the stock market, or more tangibly, every other investor just like you, is theoretically working with the same information that you have. If there's a ton of media coverage on a specific company because they just released some groundbreaking technology or because they're about to report record profits, those data points will have already influenced the price of the stock the second they're announced. They're baked in, meaning you're not buying into the stock when it's maybe not overpriced, but certainly not discounted in the way that you might think. Of course, the exception to this is insider trading, where you have knowledge about a company that the general public does not, which is why it's hella illegal. So what do you do instead of stock picking? Well, you follow the science and choose broad market index funds that represent the stock market as a whole. Some people really love stock picking though, and to those people I say, allocate a certain percentage of your portfolio, maybe 10 or 20% to stock picking, and then put the rest in an index fund. This lets you choose stocks that you have personal attachment to while still diversifying your portfolio up enough to set you up for long-term success. In a similar vein, investing strategies from get-rich-quick financial gurus are not a very secure way to build wealth over time. You may remember the GameStop short squeeze that happened a few years ago that left many lucky investors with some pretty crazy overnight profits. The various online financial communities quickly tried to find other stocks in similar positions, and there was a ton of videos and Reddit threads and TikToks that came out by gurus claiming they had found the next big thing. And many of those investors who profited heavily off of the GameStop situation lost all of their profits when they tried to repeat their unique success with something else. A very general rule of thumb is to always consider what incentivized the creation of the content that you are consuming. If you're seeing videos in your recommendation feed saying things like, "This unknown stock will get you 500% profit in 6 months," ask yourself, how does this person have knowledge that the rest of the public does not? And how are they being compensated when I consume their content? On YouTube at least, views equal AdSense money. It doesn't matter if your content is founded in reality or not. As long as people are watching in a meaningful capacity, YouTube will write you a check every single month. And at this point, you're probably thinking, well, Alex, aren't you a financial guru too? Well, there's a really big difference between producing educational content that's backed by decades and decades of financial research versus TikTok accounts pushing untested new cryptocurrencies, especially when they get a kickback from doing so. At the end of the day, while there are some shortcuts in investing, there are no shortcuts that reliably work in the long run, and you will be much better served by choosing an investment strategy focused on long-term gains and just sticking to it. I know this is really hard advice because if you're anything like me, you research everything and completely overanalyze and constantly want to make sure that you're doing the best, most optimal thing. But honestly, the reality is, the more times you think about your investment strategy, the more times you pull up your investment portfolio to check on its performance, the more opportunities you're creating for yourself to make an emotional decision. I've had days where I've lost more money in my investment accounts than I make in a single paycheck, and that can be really, really scary. But then I check again 24 hours later and the market has completely recovered, like that little blip never even happened. If I opened up my portfolio and saw that huge loss, I might have been tempted to sell off some or all of my investments in an attempt to reduce further losses. But that would have been a huge mistake because I would not have benefited from the rebound that occurred right after. At the end of the day, you just need to trust that you set up your investing strategy in an efficient, purposeful way, and constantly checking and tweaking it is not going to meaningfully change your long-term outcome. Maybe just check once per month. Set a calendar reminder and limit yourself to checking just on that day, especially if you know you might have a tendency to check more times than might be healthy. Look, the advice to be an emotionless robot is all well and good, but when all is said and done, you just need to be aware of your own flaws and choose an investing strategy that sets you up for as much success as possible in the long term. And if that means breaking some of these rules, go for it. Maybe you feel more motivated to invest if you have some personal attachment to the companies that you're investing in. Maybe you're more likely to set aside money each month to invest if you allow yourself to choose the day that you enter the stock market over a time period of a couple weeks. Maybe checking your investment portfolio once or twice a week helps you sleep better at night. The important thing is that you're aware of your own human tendencies to work against the optimal, efficient, perfect investing strategy and compensate for them in ways that make you feel good about your financial choices. If you liked this video, I have another video on specific mistakes that you might be making with your Roth IRA that goes into a lot more detail, which I'll link up here and at the end. And as always, if you learned something, please consider dropping a like and subscribing if you want to see more content just like this. Thanks all for watching, and I will see you all next time.